Hello and good morning friends, welcome to the CEC-UGC live lecture. Dear friends, as you know that we are carrying a series on financial accounting and so far we have conducted 11 sessions under the series financial accounting. This is the 12th session and in this lecture we would be discussing on concepts of capital, revenue, expenditure and receipts. We would be conducting this lecture in two halves and we believe that this session would also be very beneficial for you. And for the discussion on the topic, we have once again within our studios Mr. MC Sharma. Mr. MC Sharma is an Associate Professor in Department of Commerce, Shaheed Bhagat Singh Evening College, University of Delhi. So, I would like to welcome our guest under whose guidance we would be discussing on concepts of capital, revenue, expenditure and receipts. So, without wasting any time, I would like to welcome our guest, Mr. MC Sharma. Hello, sir. Welcome
Hello.
to the EduSec lecture.
Thank you. Dear friends, in our last lecture, we discussed the accounting process cycle of the trial balance. We know that the trial balance is a list of ledger account with their balances and the debit total agrees with the credit total. So, its main objective is to check the accuracy of the accounts and also prepare a base to prepare financial statements. We discussed three methods of preparing trial balance: balance method, total method, balance and total method. I also explained you some tips how to prepare the correct trial balance and limitations of trial balance. After that, we discussed the different type of errors which may be disclosed by the trial balance or may affect the trial balance and sometimes may not affect the trial balance. So, detection of the error before preparing financial statements or final accounts is very important and correcting them. As far as the rectification of errors and omissions is concerned, we shall discuss these topics after preparing financial statements topic. Reason being, there are the three stages of rectification of errors. First is before preparing trial balance, second is at the time of preparing trial balance and third is after preparing final accounts. So, after preparing final accounts, we shall discuss all the three methods or three stages of rectification of errors. Now, today we are discussing the concept of capital, revenue, expenditures and receipts. As you know that preparing financial statements is the most important step in accounting process, because it provides to the users of information the results of the business, that is income statement and the balance sheet provides the financial position to the users. So, before preparing financial statements or final accounts, it becomes very important to understand how to treat the different type of transactions in financial statements. And so, for that purpose, today we shall discuss the capital and revenue. Another thing I would like to tell you that we are following the model syllabus of financial accounting specified by the UGC. So, in that cycle, today we are discussing concept of capital and revenue. Okay. As far as the transactions are concerned, we know that there are many types of transactions in business, which we have to record in the books of accounts. So, their treatment of different transactions in the financial statements depends upon the nature of transactions. As far as the nature of transactions is concerned, it may be classified into two categories: capital nature of transactions and revenue nature of transactions. So, with reference to the nature of transactions, this topic today's topic is important. Then what do we mean by capital nature of transaction? When we can say it is a capital nature of transaction or revenue nature? So, capital nature of transaction depends upon that benefit from the transactions are derived for which period, short term or long term. When benefits are derived from the transaction for the short term, that is usually within 1 year, then it will be categorized as a revenue nature. While when benefits are derived for the long term, then the transaction is considered of capital nature. Another criteria is recurring and non-recurring aspect. When the transactions are of recurring nature, it means they are repeated in day-to-day business, ordinary course of business, like purchase of goods, then payment of expenses. So, all these transactions which are recurring, they are called of revenue nature, because they are done in ordinary course of business. While the transactions which are of non-recurring nature, it means they are not repeated frequently in day-to-day business activities, then they are non-recurring, and when the non-recurring transactions may be classified as capital nature transactions. So, when they occur in ordinary course of business, so that will be treated as revenue nature of transactions, and while they are not in ordinary course of business, they will be treated as capital nature of transactions. So, in this way we identified 3 criterias: one, ordinary course of business; another, recurring or non-recurring; and the benefit derived for short term and long term. On the basis of these 3 criteria, we could classify the different business transactions into 2 categories, that whether they are the capital nature or revenue nature. Why we are categorizing these transactions? We are categorizing these transactions because most of the revenue nature transactions are treated in the income statement or profit and loss account, while capital nature of transactions are basically transferred to the balance sheet or the fixed assets items or fixed liabilities, non-current. So, in that way, this is the basis for before preparing the financial statements. Now, we would like to first explain the concept of capital. Although the meaning of capital we have already explained in last few lectures, some lectures, again we would like to explain it. The meaning of capital, as far as the meaning of capital is concerned, capital may be referred as the amount in terms of money or assets having money value which is invested by the owner in the business. So, whenever we ask some person how much is your capital, so he will say how much money he has invested in the business. And another way, capital represents the cash and other assets owned by a business. The business is owner of the assets, then it is a capital amount. So, as we know that all the assets on the face are owned by the business, but a part of the value of the assets is financed from liabilities. So, basically the capital, when we mean that we could calculate total assets minus liabilities, that is external liabilities. So, it is basically accumulated wealth of the business. So, that is also term is used. Then capital can also mean stock or ownership in the company. In case of a company, we know that the capital is invested in the form of the shares. These shares, when these are fully paid, may also be converted into the stock. There is a one point of difference, that the stock may be sold or purchased in any part or any fraction, while the shares cannot be sold in fraction. So, these are the different concept or aspects of the capital. Another aspect of capital is used in business when we do the analysis of financial statements, that one term is used, capital employed. This capital employed means the long term funds invested in the business, and these long term funds may be invested by the owners, and it may also include the borrowed fund, that is the long term loans and debentures amount. So, in that way the capital term sorry, so is used in the different aspects, but here when we mean the capital, So, capital basically means the long term nature of the transactions. Now, the another concept which we want to use, that is income or revenue. As far as the revenue is concerned, this the or income is concerned, we call we mix a bit both of them, the interchangeably used in some business. So, in accounting the term income refers to the business income or accounting income, and income is increases in economic benefits. Income is increase in economic benefits during the accounting period in the form of inflows or enhancement of assets or decreases of liabilities that result in increase in equity other than those relating to contributions from equity participants. So, this is basically given in by the IASB, that is International Accounting Standard Board, in their framework. We could simplify the meaning of income. So, income is therefore an increase in the net assets of the entity during an accounting period, except for such increases caused by the contributions from owners. If owners has contributed some money, then it will not be considered as the part of income. That is basically the capital nature of receipt, which we are going to explain further. So, in accounting, income means basically the business income or accounting income. Now, what is the business income? Business income is income of the business which they have earned, or we have just discussed that the increase in the net worth or total value without considering the contribution by the owners. So, the business income is based on actual transactions. When a business do some transactions and earn some money, so it will increase the assets of the business, and so that increase it on the basis of actual transactions. It is based on accounting period concept. Income although may be calculated by for any accounting period, but normally that accounting period should be specified, and in accounting this accounting period is the 1 year. So, at present we use the financial year as accounting year starting from 1st April to the 31st March of the next year. So, whenever we calculate the business income, this business income must be related with accounting period concept. When we want to calculate or identify the business income, we have to follow the two principles, that the measurement principle and the recognition principle, which we have already discussed. There is one accounting principle, that is the revenue recognition. So, how and when the revenue should be recognized? So, when the revenue must be identified and recognized, and the revenue must be measured in terms of the money. So, in that way the business income, when we calculate, we have to keep in mind these two fundamental principles of accounting. Business income requires identifying and measuring cost. When we talk of the net income is basically based on the gross revenue or the total income minus expenditures incurred to earn revenue. So, it means on the one hand we need to identify and recognize the revenues or income, and on the other hand we need to identify and recognize the cost and expenses incurred. So, if we want to calculate the net income correctly, we must understand how to identify the different type of revenues and how to calculate the different type of the expenses or expenditures incurred. Another accounting principle which we have studied, that is the matching concept. According to matching concept of accounting principle, that the revenue of a particular accounting period should be matched with the expenses incurred in the same accounting period. So, if we want to calculate the business income, we have to follow the matching concept. So, accounting period, matching concept, revenue recognition, measurement of revenue, expenses, recognizing expenses, all these the related accounting principles must be used to identify the business income, to calculate the business income. Okay. So, we were talking of the income and that there are the one classification of income, that is the gross income versus net income. Gross income is the total revenue of the business during an accounting period. If you see, if you check from the new format of income statement or profit and loss account given by under the new Companies Act 2013, you will find in the income parts that the operating revenue. This operating revenue basically shows the sale of goods from the and from services. So, this is the gross revenue, but after deducting the discounts and allowances for the goods returned by the customers. As far as net income is concerned, which we also call the profit, the profit for a given period is derived by deducting expenses incurred to earn revenues from gross income. So, these are the two concepts which are commonly used, that is the gross income or gross revenue and the net income and the net revenue. Although when we prepare the financial statements, we shall find the different type of the concept of income. After gross income, we need to make adjustment for the income tax and some other items. So, different type of income concept, but initially we could learn only these two, gross income and net income. Now, I would like to discuss the expenditure, because this expenditure part is very important. Many type of expenses are to be incurred by the firm in the business. Expenses are or expenditures are the amount incurred by the firm to earn revenue or for any other purpose. So, these expenditures may be classified into three categories: capital expenditure, revenue expenditure and deferred revenue expenditure. So, first we would like to discuss the capital expenditure. What do we mean by capital expenditure? Capital expenditure benefits the business for a long period and creates a tangible or intangible assets for the business. It also helps in generating revenue for the business. Normally, the amount involved in capital expenditure is substantial. So, while identifying the transactions, nature of transaction, I explained that the capital nature of transactions benefits for the long term. So, one aspect of identifying the capital nature is the benefits are derived for which period, short term or long term. If the benefits are derived for the long term, just for example, if firm has purchased furniture, then the benefit from furniture shall be derived for the long term, maybe 5, 6, 7, 8, 9, 10 years and more than that also. So, the one criteria of identifying capital expenditure is it should benefit for the long run. Then it creates tangible or intangible assets for the business. So, most of the time if the capital expenditures are incurred, it will create some assets that may be tangible or intangible. Tangible assets are land, building, plant, machinery, furniture, motor car, any other asset also. Tangible assets are those assets which have the physical existence and can be seen, touched. So, when we spend some money or it creates a tangible asset, and that is for long term use. So, then it is the capital expenditure. It may also create intangible assets. Intangible assets includes like the goodwill, copyright, patents, trademark or any other item. Some licenses, acquiring some licenses for a long term period. So, these are the capital expenditures may benefit or create that. Another is criteria, it also helps in generating revenue for the business. If we have purchased a plant, so plant will help in production and of the goods and these goods may be sold. So, the purchase of plant will help in generating revenue. So, another criteria for the capital expenditure is that the amount spent will help in generating day to day revenue for the business. Another point which is added, normally the amount involved in capital expenditure is also substantial, means the huge amount. So, amount spent is not a nominal, amount spent is the large. If you want to buy a motor car, so a car for the business executives or a truck for the carrying goods, so it is not the small amount, it is a substantial amount. So, these are the different criteria on which you could identify whether expenditure is the capital expenditure or revenue expenditure. So, one is the period, that should be long term, able to create some capital asset, may be tangible or intangible. The asset will also help in generating revenue for the business, and amount involved is the large. Now, we would like to discuss some of the examples of capital expenditure. First is acquisition of a tangible fixed assets. So, all money spent on acquiring a permanent asset or permanent tangible fixed assets are treated as capital expenditure, or these assets are used for a long time. Now, this point is to be explained further. Acquiring a fixed assets, it means you purchased a plant. So, the purchase of plant is acquiring an asset, but it is not always necessary that the asset is purchased from others. It may also be created by the people. When the firm itself is constructing a building for its factory or a office, then it is also the amount incurred on creation of the tangible fixed assets. Then another example is that extension or improvement in fixed assets. The fixed asset may be extended. It means already a asset, the building is there, but now we want to create another 2-room office for the our security staff or as a record room. So, it is the extension of the building. So, if any amount is or expenditure is incurred on the extension of a fixed asset, that may be building, that may be plant, then we need to categorize this as capital expenditure. And as far as the improvement in fixed assets is concerned, if any substantial amount is incurred in the improvement of the fixed assets to improve the profit earning capacity of the asset, then it will also be the part of the capital expenditure. Sometimes the investments may be made in the shares, debentures and other financial securities of other companies for a long term purpose, then this is also the investment, this which we call is also the capital expenditure. Acquisition of an intangible fixed assets. Intangible fixed assets may be some goodwill, copyright, patent, trademark or a license. So, any expenditure incurred on these items will also be treated as capital expenditure, but it is important that any renewal fees that or any annual maintenance fees is paid, then it is treated as revenue expenditure. Then development expenditure. Expenditure incurred to bring a scheme into reality to make it productive is called development expenditure. Nowadays, a lot of money is spent by the companies on R&D, research and development items, and sometimes some companies, like in case of the mines, before using or plantation unit, housing projects, they have to incur a lot of expenditure to create the infrastructure or for that purpose. So, these are also considered as the capital expenditure. Now, how this should be treated? Normally, when a capital expenditure, this is debited to the particular asset account which is created, and we know that fixed assets are subject to depreciation. So, at the end of the accounting period, as per depreciation policy and methods of the company, the depreciation is charged, depreciation loss nominal account, depreciation account is debited and asset account is credited. When we prepare the financial statement, depreciation is shown on the debit side of income statement or profit and loss account, and the assets are shown at the written down value, that is cost minus depreciation. So, this is the capital expenditure. So, we in this session have discussed with you the concept of capital revenue and capital expenditure. Thank you. Hello friends, welcome to this second session of today's lecture, and now we shall discuss about the revenue expenditure. Revenue expenditure may be defined as an expenditure which benefits the company for a short period. That short period is normally that the benefits are derived within a year. Such expenditures are necessary to maintain the assets to generate the revenue income in ordinary course of business. So, again when you want to identify the revenue expenditure, what criteria you should apply? One criteria is the period of benefit. If this period of benefit is the short period, that is the benefits are derived within 1 year, then you should could identify this as the revenue expenditure. Just for example, you are paying the rent monthly rent. So, rent is for the month, benefit shall be derived within a month. So, it means it is a revenue expenditure. You paid the salary to the staff. So, the salary to the staff, the benefit normally salary is paid after the period monthly. So, benefits is already derived and for a month only. So, you pay the monthly salaries. So, if you see that day to day expenses, they can easily identified as a revenue expenditure on the basis of the period. Another criteria is that these expenditures are necessary to generate revenue. If we want to produce the goods, we need to pay wages, and goods produced shall be sold in the market. So, we need to pay the salaries for the staff, the rent of the showroom expenses, salesman salary, advertisement. So, all these expenditures are necessary to generate revenue in ordinary course of business. So, by spending some these expenditures, another thing to maintain the assets. We purchased a building, that is the capital expenditure. But to spend the money on the routine repairs and maintenance, whitewash and any other. So, all these expenses are necessary to maintain the assets, otherwise the assets may be deteriorated very fast and we could not derive the benefit for the specified period in that good manner. So, in that way the revenue expenditures are identified, that the period for which benefits are derived, why it is necessary, and amount spent is also depending upon the size and nature of the firm is the normal amount spent. Now, we discuss some of the revenue expenditure examples. Recurring expenses. These are the day to day expenses which are of the recurring nature and for running the business. Just for the wages paid to the employees for in manufacturing the goods, or then salaries are paid to the staff of that the office or sales department or any other department, rent paid for the office building and the factory, etc., electricity charges, telephone charges, nowadays mobile also, postage, telegram, and all these are expenses are of recurring nature, which are to be spent in the business for day to day or maintaining the ordinary course of business. As we know that in business, either there is a sale of goods, manufacturing and sale of goods, and the sale of services. So, when a company is a manufacturing company, so that the cost of raw materials will also be part of that revenue expenditure, and in case of a trading company, the cost of the goods purchased for resale, that will be the part of revenue expenditures. So, whatever the goods are purchased, these are the considered as the revenue expenditure. Although the some part of the goods or material not consumed during the year, it is carried forward to the next year. So, it is not the part considered of expenditure of the current year. So, why we are making this adjustment? Due to the accounting period concept and due to the matching concept. We need to match the income of the current period with the expenses of the current period. So, the goods which is not sold during the year, the cost of such goods is not the part of the current year expenses. Then operating expenses, we need to operate the machinery, we need to operate the business, vehicles, and so in this operating process, we have to spend some expenditures. Just for example, for machinery, the power and fuel to run the machinery, machine operators expenses, lubricants, and some other spare parts which are to be replaced frequently. And in case of the motor vehicle, running the motor vehicle, that is the car, truck, and that is the cost of petrol and the diesel, lubricants. So, all these expenses, power and fuel, in that case the power if not supplied by the electricity supply company, then we need to install a generator and spend the money on the diesel. So, all these expenses are the operating expenses nature, which are also the revenue expenditures, because benefits are derived normally immediately within a short period, and these are necessary to run the business. Then there are some other expenses, that is the maintenance expenses, maintenance of the fixed assets, machinery. So, routine repairs and maintenance on building, plant and machinery, furniture. You know, in offices that the building is to be whitewashed or painted, furniture is painted frequently, that is normally yearly, 2 yearly or 3 yearly. So, these are also the considered. Then depreciation. So, depreciation is not a cash expense which is incurred by the firm. It is basically already assets has been purchased. So, decrease in the value of asset due to its wear and tear and passage of time, and sometimes the obsolescence of the reason for this. So, depreciation is decrease in the value of the assets, and it is treated as the revenue expenditure. Now, the question arises how to treat the revenue expenditure in accounts. As we have already studied the journal entries and ledger accounts and the different type of subsidiary books, at the all these expenses are when incurred, the expenditure accounts are debited, cash or bank account or a liability is the credited. All these nominal accounts are called that the expenditures are nominal accounts, and all these nominal accounts are closed at the end of accounting period, and they are transferred to the debit side of trading and profit and loss account. Some expenses may belong to the purchase and manufacturing of goods, then these accounts are transferred to the debit side of trading account. For example, the purchase account, wages account, power and fuel account. So, all these expenses are debited to trading account, while the other expenditures like office expenses, salaries, rent, insurance, any other item, telephone expenses, stationery and printing, all these are the indirect expenses considered, and these are transferred to the debit side of profit and loss account. They may also belong to the selling and distribution expenses, financial expenses, depreciation. So, what we find that every year we need to close the nominal account, so that the accounting period expenses and can be matched with accounting period incomes. Now, we would like to compare the capital expenditure and revenue expenditure. The first criteria for the difference is objective. The objective of incurring capital expenditures is to create the tangible and intangible fixed assets, while the objective of the revenue expenditures is to conduct the business, day to day business activity. Period of benefit. As we have already discussed, the capital expenditure benefits the firm for the long term, while the revenue expenditure benefits the firm for the short term, or in other words we could say the benefits are derived within 1 year. So, it is the short term benefit. Then how they influence the earning capacity? Capital expenditure increases the earning capacity of the business. If we have bought a new plant, the new plant will help in increasing the production, and the increase in production will help in the increase in sales or revenue. So, it will enhance the revenue earning capacity of the business. While the revenue expenditures are concerned, they do not increase the earning capacity. Basically, they help to earn the revenue during the current years. So, that is an aspect. The next is accounting treatment. As we have already discussed, again I will explain. Capital expenditure is shown as an asset in the balance sheet, and the revenue expenditures are shown on the debit side of trading account and profit and loss account. Then depreciation. Depreciation is charged on capital expenditure, while in revenue expenditures it is a part of, considered as a part of revenue expenditure. It is not charged on any other expenditures. So, these are the some points of difference which differentiate, but the basic criteria while identifying you could use the benefit of the period for which period the benefits are derived, and creation of the fixed assets or enhancement in the earning capacity. There are certain revenue expenditures which are treated as capital expenditure. So, we would like to explain, because sometimes they are confusing for the new learners. One of such example is wages. When wages are paid for the construction or erection of a building or for installation of a plant or machinery, they are treated as capital expenditure. So, if some wages has been paid to the labor for unloading a plant and machinery and installing it, so then it will be part of the capital expenditure. We have also studied this in the cost concept when we are creating a fixed asset. So, any such expenditure, that is installation charges or wages paid on erection, so this will be the part of capital expenditure. Another is the transportation cost. Transportation cost may be for the purchase of goods, then it is a revenue expenditure. But when freight and carriages are paid for acquisition of an asset, these are treated as a capital expenditure. A machinery has been purchased and the vendor has said that he will not pay the freight charges, and we have paid rupees 5,000 for a truck to carry this machinery to our plant or factory. Then this transportation cost will be the part of capital expenditure incurred on the plant or machinery. Sometimes the raw materials, goods in stores may be consumed to manufacture a fixed asset. Although such transactions we have already discussed, but again that a person is dealing in the building material and he has purchased a building or the go down to store that, and the material of some building material has been spent. So, the cost of material spent on manufacturing a go down shall be the cost of the go down. So, it will be treated as capital expenditure. Repairs. Most of the time the repairs are considered as the revenue nature expense, and revenue nature expense means they will be shown in the debit side of profit and loss account. But sometimes a second hand asset has been purchased by the firm, then some expenditure may be incurred on repairing this asset and overhauling to make it the productive, commercially viable. So, all these expenditure, repair expenditure or overhauling charges shall become the part of the cost of that asset. Sometimes legal expenditures are also to be incurred. Just for example, you may be knowing that your father or yourself or family has purchased a house. House was purchased suppose for 25 lakh, but later it is told to you that the 2 lakh has been incurred over and above the cost of the house, the purchase price of the house. Then these are the registration charges, stamp duty, legal charges paid to the lawyer or the legal help assistant or consultant. So, all these are the legal expenditure. If any legal expenditure has been incurred to acquire the title of some fixed assets, these will be also part of that. Then interest on loan. Interest on loan is a revenue nature expense. A firm has taken a loan, but in a particular case, like if the loan has been taken for purchase of fixed asset, and so interest is being paid, but the fixed assets take the 3 months to start the commercial production. Then the interest paid on the loan raised for the acquiring the fixed assets for the period before starting commercial production, it is treated as capital expenditure. So, interest on loan for 3 months shall be added to the cost of that fixed asset. Now, we would like to discuss some examples whether they should be treated as revenue expenditure or capital expenditure. So, some of the expenses are given here. The one is the cost of removal of stock from old workshop to new workshop, rupees 3,000. So, a firm has shifted from its workshop from one building to another building, so, and rupees 3,000 has been incurred. So, this is the ordinary course of business and it is considered as the revenue expenditure. Legal expenses incurred for purchase of building. Just now we told that it is the capital expenditure to acquiring a fixed asset. Then paid whitewashing charges rupees 1,000. Whitewash are normally to maintain the building. So, this is the revenue expenditure. Then purchase a motorcycle for marketing manager. Motorcycle is a tangible fixed asset. It will benefit for long term, 5-year, 10-year. So, this is treated as capital expenditure. Next is rupees 10,000 was paid as compensation to a discharged employee. An employee has been discharged or terminated from the organization and compensation of rupees 10,000 has been paid to him. So, it is in ordinary course of business, some employees may be terminated by the firm. So, as per their agreement of the service, they can be paid as compensation. So, these are some expenditures which you need to consider how they are helping the firm and what is the period of benefit. Now, we would like to discuss another category of expenditure, and this category of expenditure is very important, that is deferred revenue expenditure. I have specified here the definition given by the Institute of Chartered Accountants of India. Deferred revenue expenditure are those expenditure for which payment has been made or a liability has been incurred, but which is carried forward on the presumption that it will be of benefit over a subsequent period or periods. It means that in simple words, a revenue expenditure which will benefit the firm for more than 1 year, maybe 2 year, 3 year, 4 year, then such expenditure is known as deferred revenue expenditure. Deferred revenue expenditure means it does not create a fixed asset or tangible asset, but this is the revenue expenditure, does not create any asset, so, but benefit for the more than 1 year. There may be certain examples for this deferred revenue expenditure, and one of the example is the heavy expenditure has been incurred by a firm on launching a new product. So, that the expenditure incurred on launching a new product may benefit the firm for 2 year, 3 year like that. So, on that basis this expense shall be treated as the deferred revenue expenditure. So, it benefits for more than 1 year. So, we should know how to treat this in accounts. As far as the accounting treatment of deferred revenue expenditure is considered, we need to estimate the period of benefit. A period of benefit is 2 year, 3 year, 4 year, whatever it is, it should be estimated first. Then this expenditure is written off over the period of benefit by debiting to profit and loss account, normally on the basis of the straight line method or equal installment method. Just for example, the advertisement and new launch spend rupees 30,000 and it is expected to benefit for the 3 year. It means rupees 10,000 may be written off every year over the period of 3 years. Now, the question arises, what about the unwritten off amount? The unwritten off amount, the balance sheet, normally it is shown under the miscellaneous expenditure heading and the asset side of the balance sheet in case of the proprietorship and partnership forms. In case of the companies, this miscellaneous expenditure is considered as the other non-current asset, because it will be written off over the more than 1 year. So, it is the other non-current asset. What is the difference between deferred revenue expenditure and revenue expenditure? One is the period of benefit. This is the very important difference, that the revenue expenditure benefit the firm for a short period or up to 1 year only, while the deferred revenue expenditure benefits the firm for more than 1 year, that may be 2 year or 3 year. And on the basis of that, the accounting treatment is also different. The revenue expenditure, the whole amount is debited to the profit and loss account in the year of incurred, while this deferred revenue expenditure is written off over the period of benefit for to the firm by on the basis of some policy and some method. We could discuss one more example where the expenditure incurred is capital expenditure or revenue expenditure or deferred revenue expenditure. That one first item here given is wages paid to workers for converting raw material into finished goods. So, this expenditure has been incurred in day to day business activity. So, it is the part of revenue expenditure. The custom duty paid on imported machinery. Machinery is a tangible asset and the custom duty paid has been incurred in creation of the machinery or buying acquisition of the machinery. So, it will be treated as capital expenditure. Office rent paid in advance for 3 years. Office rent paid in advance. So, office rent is all the revenue expenditure, but the 2 years rent for the coming period, that is the benefits are not derived in the current year. So, the rent for that period on the basis of accrual concept shall not be the part of the current year expenditure, although it is the revenue expenditure. Heavy expenditure incurred on advertising a new product, that is deferred revenue expenditure, as I told you, and this will be written off over the period of benefit. Then expenditure on development of a product. When a expenditure is incurred on development of a product, so this product development expenditure are considered as the either capital expenditure, sometimes when the some patent is acquired on that basis or registered, or if patent is not acquired, then it may be treated by the company over the period of benefit, it may be written off. Amount is spent to overhaul a motor truck purchased on a second hand. So, a company has purchased a motor truck, it is a second hand and some amount has been spent and its repairs and overhauling. So, it will be treated as the capital expenditure, because it is an acquisition of the asset. Now, we would like to discuss the term capital and revenue receipts. Receipts may be defined as any amount received by the firm. Now, the again question arises, the basic question which I started this lecture, that the identifying the nature of transactions, that is the capital nature or revenue nature. So, if firm receives the many payments in the business transactions ordinary course of part, so we need to identify that whether this receipt is a capital nature receipt or the revenue nature receipt. So, what do we mean by the capital receipt? Capital receipts are the amounts received normally of non-recurring nature, not obtained in the ordinary course of business and not available for payment as profits to the owners. So, capital receipt criteria are: one is non-recurring nature. So, it should be non-recurring nature and not obtained in ordinary course of business. Ordinary course of business is sale purchase of goods and services. So, it is not received during normal business activities and not available for payment as profit to the owners. So, any amount which cannot be distributed to the owners as profit shall not be considered as the revenue receipt, it shall be considered as capital receipt. So, if we simplify this part, we could define that capital receipts are the amount received as additional capital from owners, loan received, sale proceeds of fixed assets. So, if the owners have invested some capital in the business, additional capital, business has started the 10 lakh and after some time the rupees 2 lakh more invested. So, this rupees 2 lakh invested by the owner or partner in the firm, it will be considered as the capital receipts, or the issue of shares later on, this is also the part of capital receipts. Then loan received. A firm or a company may borrow the loan from any bank or financial institution or from any other entity. So, this loan received, amount of loan received is the capital receipts. And sale of proceeds of fixed asset. Any existing fixed assets, whether it is a tangible or intangible, it can be sold by the firm and the money can be received. So, this will also be treated as the capital nature receipt. So, in a way what we could find its impact on the balance sheet, that capital receipts either increases the liability or reduces the asset of the firm. So, if additional capital is introduced, it will increase the liability. If loans are taken, it will increase the liability. If any asset is sold, it will reduce the assets of the firm. So, in this way the capital receipt either increases the liabilities or reduce the assets of the firm. Capital receipts do not affect the profit or loss of the firm. As we told that the capital receipts cannot be paid or distributed as the profits to the owners. So, they do not affect the profit or loss of the firm. Then revenue receipts. Revenue receipts just opposite to the capital receipts. Capital receipts are non-recurring nature, while revenue receipts are of recurring nature. Capital receipts are not obtained in ordinary course of business, while revenue receipts are obtained in ordinary course of business, and this ordinary course of business is mainly through sale of goods and services. Amount received does not need to be returned to anyone, while the capital receipts need to be returned. Most of the, particularly the loans taken or the capital introduced by the owner, because whenever the business shall be closed, the capital shall be returned to the owners. Revenue receipts are treated as income and shown on the credit side of profit and loss account. When we shall prepare the financial statement, so it is important that all revenue receipts are considered as income and shown on the credit side of trading and profit and loss account. Revenue receipts net of revenue expenses and expired portion of capital and deferred revenue expenditure is available for payment as profit to the owners. So, in a way that if we talk of the net income or net revenue or the net receipts, it shows basically the net profit. That is the gross revenue, then the revenue, then minus revenue nature expenses and the some depreciation, that is the portion of the capital expenditure to be written off. So, the balance is the net profit which can be distributed to the owners. So, in this way we need to understand before preparing the financial statements the nature of transactions, whether these are capital nature or revenue nature. So, this will help us in preparing financial statements correctly. Thank you.
With this note, thank you, sir. Thank you so very much for giving us a productive session once again. And dear friends, if you want to give your feedback regarding this particular lecture, or if you have any queries or suggestions, then you can mail us at info.cc@nic.in. We would be meeting again very soon. Till then, take care. Goodbye. Thank you, sir.
Okay.
Thank you so very much for giving your precious time to us.
Thank you.